Roy, thanks for chatting with Livewire Markets today. What's your outlook on the Australian and the global economy as well?
Yeah, it's really interesting. Obviously, it's pretty tough today with what's going on in the Middle East, but I think the biggest focus for us has been around where we are in the cycle. Prior to the Middle East taking place, we were actually getting very constructive on the cycle. Some of the countries in the developed world, your Mexico's, your Indonesia, we're seeing really good signs of growth, and we're starting to see an upswing in industrial production. So that was giving us a lot of confidence around where we were in the cycle. I think for Australia, and then focusing on the US, I think for Australia it's going to be about inflation and how quickly that comes down. It's been surprising, for us it's been surprising on the downside. And what's really been interesting about that is sort of bonds haven't reacted to that. Consumers held up well, but I still think they might be under a bit of pressure in the second half of the year. In the US, it's been quite a surprise that growth has held up so well. Everyone was talking about the recession that we haven't had, and it's really interesting that today, you can see some of the reasons why that growth's held up really well. Mm-hmm. Fiscal spending, financial conditions are easing a fair bit, so it's actually quite interesting, and the outlook for the US looks pretty good at the moment.
Roy, last time we had a chat, I think your outlook on the interest rate cycle was maybe one more. Where are you at now in terms of your thinking on the interest rates here in Australia?
Yeah, well, new governor in place, so I think it's ultimately down to two things: employment and inflation. We would not be surprised that in the coming months that, especially if inflation prints a little bit higher than expected, which is likely, that we might see one more. Mm-hmm. So we haven't changed in probably that view, but and I think it also comes back to the governor probably trying to show hawkishness in displaying that she's not going to be a dove for her tenure. The RBA's probably going to be close to finished.
Yeah. Aside from the governor and employment, are there any other factors that go into the mix when determining your outlook for interest rates?
Absolutely. Supply and demand's one thing. I mentioned the US before, and we changed our view on bonds. We've been overweight bonds for probably 12 to 15 months. And what was quite interesting, probably a couple of months ago now, we changed our view when the US Treasury announced how much bonds they were going to be, especially long bonds, issued into the marketplace. And that sort of changed our outlook. And in some ways we've been disappointed because our view was that rates would be lower because inflation was going to continue to surprise on the downside. So it was frustrating for us, that trade. Mm-hmm. But in some ways now I think it just means that interest rates are sort of getting close to their peak, and it's sort of providing opportunities for us.
Roy, you talked a little bit already about changing your view slightly. Let's talk about the practical elements of how that manifests in the portfolio. So what are you focusing on now? What are some of the trades that you've been doing? How has the portfolio construction changed in the last, let's call it 3 to 6 months?
Once we realised that rates weren't going to rally, and we were seeing supply come to finance the US fiscal supply, we sort of looked at yield curves, and back in that period the yield curve was flat, and what I mean by flat is that there was no difference in interest rates between the 3-year bond and the 10-year bond. And we felt that the curve was far too flat for the environment that we were looking into the future. So we, across all our portfolios, we put in some steepening strategies across mm-hmm. our portfolio, which has worked for us, and we still think the yield curve can steepen further, and that's more long rates selling off and sort of the front end of the yield curve being sort of held by central banks nearly being close to finish. The other thing that obviously higher interest rate does from a credit point of view is if it's higher for longer, which is probably the environment we're in now, what does that mean for companies who have a lot of leverage or in some ways have asset revaluation process going on at the moment where they're probably expecting rates to start to fall and they're going to be staying a lot higher. So how does that impact the credit for those companies and what their intentions are in the future is really important for our construction.